Okay, move to the last part of the top. This class is the financial markets. Financial system works on the basis that there is a group of people who have surplus funds. Okay, as we said before, surplus fund and wish to save the surplus funds for future consumption, and there is another group of people who have insufficient fund or shortage of funds, request to have the additional funds for their projects or for investments. So the two parties are brought together through the financial markets. Okay. And we have primary market and secondary market. Primary market means the funds transferred directly from the surplus units or surplus funds to those borrowers through the issue of new securities. So here, primary market say here company A with good projects but without any money or lack of money, and here there are investors. They have surplus funds, and primary market means the company A, I issue the shares. Say here issue shares to those investors, and the investor will just pass through the money to company A. So investors can share the good results. If, for example, if the project is finally turned into the positive NPV project, and the cash generated can distribute as dividends to the shareholders, then the investors with surplus fund invest into company A can enjoy the dividends from the good projects generated. So here is the primary market, like IPO. IPO means initial public offering. Okay, company A with a lot of good projects, but it is lack of funds or lack of money to invest or to expand. And it would like, for example, it's, hey, I go to the stock exchange and I raise money from issuing new shares and finding investors. The investors just put the money into buying the shares into the company A, and then when the project finally coming is good and the company A can generate the positive cash flow to distribute to the shareholders as dividend, the investors are happy because it can enjoy the dividends from the investment. So here is partly the primary market. For the secondary markets, mean the investors buy the shares or bought company A share in IPO, and they found, okay, it's time to sell because I need money. I want to have some money back. So it sell to other investor in the stock exchange. Then this is the secondary market. It is involved a trading of securities. Involves trading of securities, and secondary market transactions do not give rise to any new securities, just trade the old shares. All right, so I hope you understand the difference between the primary market and the secondary market. So next is, what is capital market? Capital market is this market trades financial instruments with maturity period of more than 1 year. The bulk of this business is conducted on the stock exchange. Types of securities traded are shares, debentures, and Eurobonds. So capital markets is generally more than 1 year. Here's the one characteristic. More than 1 year. And securities like shares, debentures, Eurobonds, okay, which are more than 1 year's time. And next is about the money market. It is shorter than 1 year. This market is mainly for trading of short-term loans. These are wholesale markets for funds, largely between financial institutions, and no physical location. Participants include banks, local authorities, building societies, and companies. And money markets deals with hire purchase, leasing, and trade credit. Okay, we will soon cover the money market in the different charts and table. Okay, first of all, I would like to show you the characteristics of money market. What is the characteristics of money market? It is where financial instruments are highly liquidity, with high liquidity. It means very liquid. And short maturities is less than 1 year are traded. Okay, it's the characteristic of money market. Very liquid instruments, and also the maturities is very short, less than 1 year. And the purpose of the money market is to for short-term financing and short-term investments. Okay, short-term financing means because the maturity is, even the holder is less than they know there is less than 1 year, but I cannot wait for even for 9 months. I need the money now. So they would like to sell their financial instruments in the money markets in return for the money that can get earlier than the financial instruments mature. And for the investor who buy those financial instruments, because they have the holding power to wait until the financial instruments mature and have a higher return. So who are the participants? Banks, local authorities, building societies, and companies. In instruments they are selling is CDs, certificates of deposit, bankers' acceptance, U.S. Treasury bills, commercial paper, repurchase agreements. Okay, here we would like to say they have different risk profile. So in other words, they have different return. Okay, the instruments they traded include certificate of deposit, bankers' acceptance, U.S. Treasury bills, commercial paper, repurchase agreement. And here is the money market operation. There's no physical location existed. Okay, so here's a graph here in the middle is just show you how to line up between surplus funds, the investors, and also who are the money who needs the money. Okay, 3 examples. Okay, first example is 180 days bankers acceptance. Is the money instrument, financial instruments traded in the financial market. So it will the people would like or interest for these instruments with the good match of the maturity will are interest on it. And the other is food call. It has 270 days certificate of deposit and finding investors for it. And the third one is the 10-year convertible notes. Okay, so here 10-year convertible note. Okay, because it is not a money market instrument. Okay, it's in the market. It should be traded at the capital market. So it's not in the money market. And only the first two, 180 days bankers acceptance and also 270 days certificate of deposits are traded in the money market. And one investor looking for 270 days investment, so he will go for the CD, certificates of deposit, and with the other investors are interested in the short-term investment, say 6 months. So the 180 days bankers acceptance are a good investment for him because it matches his the lead for the duration 6 months. And here we show you the risk level of different money market instruments. For example, the lowest risk should be the U.S. Treasury bills. Okay, it is the short-term debt obligation backed by the Treasury Department of the U.S. government. So the issuer is U.S. government with very high credit rating, and so the risk level is very low as compared to other items. The second is the purchase agreement. Repurchase agreement. What's that? Okay, it is a repurchase agreement is party holding government security agrees to sell it to investor and buy back in a short period of time. So I have the government security, I sell to you, but I agree to buy back from you at a period of time because I need the money now. And after I put the money in my operation so that I'm confident that, say, 3 months later, I have the money to buy back the government security. So I just found a investor interest for only investing in 3 months' time to earn interest. And here the case, because the government security is treated as collateral, it is a secured borrowing. So in other words, it is also very low risk, but it's a bit higher risk than the U.S. Treasury bills because it involves a private party in it. And then is the certificate of deposit. It is a promissory note issued by commercial bank. And time deposit that restrict holders from withdrawing funds on demand. So it's a commercial bank, the issuer. The first tool is issued by the government or the U.S. government. So it's the risk rating is very good. The credit rating is very good. The risk level is very low. For certificate of deposit, it is issued by commercial bank. It depends on the risk level of the commercial bank. So if the risk level of the commercial bank is low, then this certificate of deposit is also at a good rating as well. The fourth one is the banker's acceptance. So the banker's acceptance specifies the amount of money, the date, and the person to whom the payment is due. And the issuer is also the commercial bank. And the banker's acceptance starts at the time drawn on the bank's deposit by a bank's customer to pay money at a future date. And the bank accepts or guarantees payments to the holder of the draft. Okay, so it is issued by commercial bank, and who holds it? The bank agree to pay the holder of the draft at a period of time, say 6 months. So the last one is the commercial paper. It can be issued by commercial banks or companies with good credit ratings. It is a secured promissory note, so it's not secured with maturity less than 270 days. So the risk should be the highest among all money instruments described above. Okay, so the return here, here is the lowest, and here is the highest based on the risk level. So remember, which one offered you the lowest return because of the risk? Okay, which one offered you highest return because also the risk? So here we talk about a summary of our last class. First, we talk about the financial management functions. Okay, including different investor ratios. And also the FM objective, maximize shareholder wealth. And also non-financial objective. Because of different stakeholders, like the employees, like the vendors, like the customers, like the community or the government, or different financial objective or different non-financial objective for different stakeholders. And we also share agency problem. It's about the manager. Okay, what's the agency problem? Because the ownership and the management is separated, so there will be great agency problem for the managers. And also we share about the not-for-profit organization objective. Not-for-profit organization objective. So for example, we quote a good term is value for money. And next, we talk the financial management environment. Okay, how the financial management environment affects your business, your company. For example, the government policy. We describe different government policy like the government policy, fiscal policy, monetary policy, competition policy. Okay, green policy. And also we are talking about the policy objective. Okay, and then we move to the financial intermediaries and financial markets. Okay, so we've finished the financial intermediaries and financial markets by describing the agents. For example, the financial intermediaries, what's the agents perform and what's the roles of financial intermediaries, maturity transformation, funds aggregation, and also the risk transformation. And for financial markets, we describe the capital market, which is serving for the financial instruments with maturity longer than 1 year. For example, shares, debentures, Eurobonds. And for money markets, it serves the short-term financial instruments like if we just less than 1 year, for example, like the certificates of deposits, the banker's acceptance, U.S. Treasury bills, okay, U.S. government Treasury bills. So we describe all these, and I hope you understand it well because all the financial management functions and financial management environments are the topics that will be or quite sure in section A and section B. So thank you for joining our class.